The fear of missing out. If you're honest with yourself, you felt it before. You see price moving, you see a setup forming, and your heart rate increases a little bit. And suddenly you're not trading your strategy anymore. You're trading your emotions. And that right there is where most traders start losing money. What is FOMO? Genuinely. FOMO in trading happens when the fear of missing an opportunity becomes stronger than your discipline. And it usually shows up in two ways. Type 1 is early entries. You enter before confirmation, price is approaching your level, but the candle hasn't closed yet. But in your mind, you're thinking, if I don't enter now, price will run without me. So you click the button early. And a lot of times, the market immediately moves against you. Then you sit here thinking, if I literally waited one more minute, I would have avoided that trade. Does that sound familiar? I'm sure it does. Type 2, late entries. This is the opposite form of FOMO. Instead of entering too early, you wait too long. You wait for the perfect entry. You want the perfect entry. You want more confirmation, more signals, more reassurance. And by the time you finally decide to enter, the move is already halfway finished. You chase the trade, and then what happens? Now your risk to reward is complete dog shit. Fear of missing out goes into emotional decisions, which turns out to be a bad trade and loss of confidence, and then you take even more emotional trades. This isn't a strategy problem, this is human psychology. So what's the human psychology behind FOMO, everybody? Huh? What's the human psychology behind FOMO? I'm glad you asked. Humans are wired to react emotionally when opportunity appears. Our brain evolved to chase scarcity and urgency. When something looks like it might disappear, our brain releases stress signals telling us to do it, act now or lose it. That instinct was useful thousands of years ago when survival depended on quick decisions, but in trading, the same instinct becomes self-sabotage. The market is not a survival situation, it's a probability game. And emotional urgency destroys probability. A powerful example is Isaac Newton, the same guy that fucking discovered gravity. Newton was one of the greatest scientific minds in history, but even he fell victim to FOMO during the South Sea bubble in 1720. At first, Newton invested early and actually made a good profit, but then something happened. The stock kept rising, people around him were getting fucking rich. Everyone was talking about it. And Newton started feeling the same thing traders feel today, the fear of missing out. So he reinvested near the top. When the bubble collapsed, Newton lost the equivalent of millions of dollars. And afterwards, he famously said,
"I can calculate the motion of the heavenly bodies, but not the madness of people."
That tells you something important. This isn't about intelligence, it's about psychology and discipline. You better apply this to practice because awareness alone doesn't solve anything. You need systems. Step 1. Whenever you feel the urgency to enter a trade, wait 30 to 60 seconds. Not when you're thinking about entering, but when your finger is literally hovering above the button. Those 60 seconds do two powerful things. They break the emotional impulse. They allow the market to confirm the setups. You might lose a little bit of precision, but your win rate dramatically increases because you're no longer reacting emotionally. Step 2. Reduce position size. If you hesitate too much, it's because you're probably over leveraged. Your brain is scared to lose, so the situation and solution is simple. Cut your position size in half. If you normally trade one contract, trade half of that. When the risk feels manageable, your brain stops triggering fear-mongering responses. Now you can follow your strategy objectively. Step 3, define your entry triggers. Most traders don't actually have clear rules, they have vague ideas. You need exact answers to questions like, what confirms my entry? What invalidates my entry? Am I trading reversals? What must happen before I click buy or sell? If you can't answer those questions instantly, you're not trading a strategy, you're gambling. Clarity removes hesitation. Clarity removes hesitation. And hesitation is where FOMO is. The real difference between winning and losing traders at the end of the day, profitable traders come down to one thing. Logical thinking versus emotional thinking. Unprofitable traders make decisions based on feelings. Profitable traders build systems that remove feelings from that process. They collect data, they define rules, they execute consistently. Trading stops being emotional, it becomes mechanical. My final message for you fucking dweebs, nothing will change unless you apply this. You can watch trading videos all day, but if you open up the charts tomorrow and trade exactly the same way, your results will stay exactly the same. Real change happens when you build structure around your psychology. So ask yourself one honest question. Do you want quick excitement or long-term mastery? Because the traders who master their psychology are the ones who eventually master the market. Hope you wrote that down. Apply the framework, and I'll see you in the next episode. This was FOMO 101.